Hello, I'm Geoff, and welcome to our third quarter 2026 market outlook. Whether you're a current client or joining us for the first time, we hope you find value in the insights from our advisors at Capital Strategies Group. As certified financial planner practitioners, we take an unbiased fiduciary approach to the work we do. We are always keeping a close eye on market movements and staying well informed. That said, just because we are sharing our insights with you doesn't mean adjustments are warranted in your portfolio. News headlines can create a sense of urgency, but not every situation necessitates immediate action or intervention. As we move through the middle of 2026, there are really two major forces shaping the economy and the markets right now. They are pulling in somewhat opposite directions. The first is artificial intelligence, which continues to fuel one of the strongest business investment cycles we have seen in a long time. The second is higher oil prices tied to the conflict in the Middle East, which have added to inflation and created new challenges for the global economy. Understanding how these two forces are working against each other is really the key to understanding where we stand today. Let's begin with artificial intelligence because it remains the larger and more powerful long-term story. For the past several years, there has been a tremendous amount of excitement and certainly some hype surrounding AI. But we are now seeing something much more meaningful than excitement alone. Companies are spending real money building the infrastructure needed to support this technology. That includes semiconductors, data centers, software, networking equipment, and the enormous amount of energy required to operate it all. According to Vanguard, AI-related investment is continuing to run ahead of expectations. Vanguard now expects the U.S. economy to grow by around 2.3% in 2026, followed by roughly 3% growth in 2027, which is meaningfully higher than many other forecasts. They believe this may represent more than a temporary economic boost. We could be in the early to middle stages of a major investment cycle that reshapes how businesses operate for years to come. Vanguard compares the size of this build-out to other major periods of economic development, including the railroad expansion of the 1800s, the growth of automobile manufacturing after World War II, and the technology of the dot-com boom in the late 1990s. Of course, each period was different, but the larger point is that new technologies often require a tremendous amount of investment upfront before their full economic benefits are realized. Here's the tension, though. In the short run, all of this investment can add to inflation by increasing demand for computer chips, construction, electricity, equipment, and specialized workers. But over the long run, AI may help reduce costs by allowing companies to produce more with the same amount of time, labor, and resources. So we could see something that feels a little unusual. AI may contribute to inflation today, while eventually helping to lower it several years from now. At the same time, the economy is dealing with higher oil prices. The conflict in the Middle East pushed oil above $100 per barrel at certain points this year. Prices have since come down, but they remain higher than they were before the conflict began. Higher energy costs affect transportation, manufacturing, company profits, and ultimately the prices consumers pay. However, analysts estimate that oil would likely need to remain above roughly $150 per barrel for about a year before the oil shock alone would be large enough to cause a global recession. So we are not currently at that level, but higher oil prices are still adding to inflation and creating headwinds, especially in areas like Europe that are not benefiting as much from the AI investment boom. This also makes the Federal Reserve's job more complicated. If the economy and job market remain healthy while energy prices stay elevated, the Fed may have less room to lower interest rates. In fact, the possibility of another rate increase has grown somewhat, suggesting rates could remain higher for longer than many investors expected. Despite these challenges, corporate earnings remain strong. The market's gains this year have been supported by stronger profits and improved earnings expectations, which is generally a healthier reason for stocks to rise. Still, investors should expect a bumpy ride. The companies building AI infrastructure may continue to benefit in the near term, but over time, some of the greatest opportunities may shift toward businesses that successfully use AI to lower costs, improve productivity, and become more profitable. That could create opportunities in less talked about areas of the market, including value-oriented companies, smaller businesses, and companies outside the United States. That's why diversification remains so important. The companies leading the market today may not be the same companies that benefit the most from AI over the next decade. So when we step back, higher oil prices are creating shorter-term inflation pressures, while AI investment is supporting growth and creating longer-term opportunities. As always, our job is to help you stay focused on that bigger picture rather than reacting to every headline. For clients of Capital Strategies Group, know that we are watching these developments closely and remain focused on keeping your portfolio thoughtfully diversified and positioned for the long-term opportunities ahead. We appreciate you taking time to join us for this third quarter economic and market outlook. If you aren't currently a client of Capital Strategies Group and would benefit from having an expert at the helm, helping you navigate this changing market landscape, we invite you to reach out to us. Take care and thank you for watching.